Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Hi guys, this is Aditya Vora here. Here's wishing everyone Merry Christmas and a Happy New Year in advance. They say risk hai to ishq hai in the stock market. After all, you can make money only if you take mindful risks in the stock market. So, as this year comes to an end, I thought let me talk about a stock which is a very risky investment. It is basically a turnaround story, and the performance of the company in contention is likely to depend on multiple factors. However, if the triggers in the business play out, then there can be a huge re-rating in the stock, and if the triggers don't play out and the management does not live up to what it plans to achieve, then the stock can be a very bad investment. Basically, in simple terms, it is a binary investment, an all or nothing type of a stock. The potential turnaround stock which I am referring to is Cineline India Limited. It is the erstwhile chain of Cinemax theatres which was a market leader in Western India 2 decades ago. I am sure this name rings a bell to many people. For people living in the western part of India, especially Mumbai, Cinemax was a go-to theatre for all of us as kids and teenagers. Cinemax was owned by the Kanakya Group, which had interest in real estate, especially commercial real estate. Well, in 2012, PVR acquired a 69.3% of Cinemax India from the promoters for Rs 395 crores, and as a result had to make an open offer to acquire the remaining shares from the public at Rs 204. Now let's fast forward to 2022. The promoters of erstwhile Cinemax are back with a second shot at the thriving multiplex business. The question is, why now? That too also after 10 years. So the thing is, PVR, while buying Cinemax from the Kanakya Group, had signed a non-compete clause for a period of 10 years. That meant the promoters could not venture in the multiplex business till the end of 2021. Now that the non-compete clause is over, the Kanakyas are back at what they were best known for. That is to run a theatre business and make money out of it. As I said, this is an extremely risky investment bet as you are betting on the promoter and his vision and execution skills going forward. So friends, let's start with the basic factors which influence the exhibition industry and where Cineline India is placed. The first parameter is the number of screens and the location of screens. After all, more screens means more revenues and profitability. To start with, the company has opened theatres under the brand name MovieMax and has 118 screens across India as on November 2022, while 2 screens in Rajasthan and 7 screens in Hyderabad were opened recently about 2 weeks ago. This brings the total number of screens to 127. Just to put things in perspective, PVR, which is India's largest multiplex operator, has a screen count of 870 screens, while Inox, which now will be merged into PVR, has a total screen count of 670 screens. In 1 year, the MovieMax screens accounted for 15% of the total PVR screens. If you look at the table below, it shows the company has a total of 118 screens under A, the operational screens, B, screens under fit-outs, and C, the tied-up screens. Now, the operational screens, 23 screens were handed over by PVR to Cineline India in April 2022 as the lease expired. All these 23 screens are in Maharashtra and are owned by Cineline, which gives them an edge to start their business. Apart from the 23 screens, for the remaining 17 screens, Cineline has bought out the screens from owners who could not manage their theatres and wanted to exit the business. The advantage is that it gets a good deal and there is no gestation period to build a theatre. The developers provide them with all the amenities. These theatres are basically ready-made assets on the books of Cineline India, and the company does not have to pay lease rent on it. The second and the third, which are screens under fit-out category and tied-up screens, are the screens which Cineline has run on lease. The tied-up screens are jointly run by the company and the owner of the multiplex. It is estimated that Cineline incurs roughly 2 to 2.5 crore of capital expenditure per screens for screens under the fit-out category. So now the question is, how can Cineline compete with these big guys? Well, the answer is that while PVR and Inox focus on metros and Tier 1 cities, Cineline plans to target Tier 2 and 3 towns and buy out standalone theatres at throwaway prices which were under stress due to COVID. Basically, in simple words, it is trying to fill the white space between the cities and the small towns. In my view, this is a very good strategy as large players like Inox and PVR would not set up theatres in small towns as the purchasing power of people living there will not support the average ticket prices and the food and beverage prices. I mean, who is going to buy a popcorn tub or a movie ticket for 400 rupees in smaller towns? So now let us look at the current operating metrics of Cineline India. With roughly 127 screens, Cineline's average ticket price is roughly 179 to 182 rupees. And the SPH, which is the spends per head, which is nothing but the average spends a customer does on food and beverages, stood at rupees 61 per customer. If you compare those statistics to market leader PVR, the average ticket price comes to 239 for PVR, while the spends per head comes to 130 rupees, which is more than double. There is no way MovieMax can reach PVR in terms of the above operating consumer spending due to its focus on Tier 2 and Tier 3 towns, but another way to look at it is the headroom which Cineline has is much higher than PVR. Even a 10 to 12% increase on ticket prices and food and beverages every year will be absorbed as the starting rates are low as compared to PVR. It won't make any sense to talk about the valuations and multiples as they mean very little from an analysis point of view at this stage since the company has just started operations about a year ago. So friends, let's talk about the strategy of the management for growth and why I believe this could be a typical turnaround story which will surprise people. MovieMax plans to have a total of 300 screens by the end of FY25. Which is an addition of roughly 185 screens over the next 2 years. That's 2.5 times increase in the total number of screens. Currently, the company operates in 20 cities and by FY25, it plans to open multiplexes in 35 plus cities in India, with higher focus on Tier 2 and Tier 3 towns. One more metric, which is the average ticket price and spends per head, which is spending on food and beverages, stood at rupees 179 and rupees 61, making a total of rupees 240 per person. The management wants to take this number anywhere to rupees 275 to 300, which in my view is a very practical and achievable number over the next 2 years. Now, for this ambitious target of 300 plus screens, the company needs funds. While last year it raised rupees 25 crores by issuing preferential warrants which got converted to shares to the promoter group and an investment firm at rupees 71 per share. That helped it with the initial cost of setting up screens and the working capital requirement. Now there are two main issues which the company faces. One is that it needs funds for future expansion, and second is the high debt the company is sitting on. The management has devised a plan which is as follows. First things first, the Kanakya Group and Cineline with its subsidiaries has interest in commercial real estate along with the hotel and shopping mall. The current gross debt stands at 257 crores as of September 2022, and the net debt after taking the cash stood at 225 crores. Cineline has targeted monetization of its non-core assets, which will generate rupees 350 to 450 crores according to the management. In pursuit of this, it has already monetized 2 commercial offices in Mumbai for rupees 21 crore and a mall in Nagpur for rupees 60 crores, thereby generating rupees 80 crores till date. Over the next few months, it plans to monetize its hotel in Goa, Hotel Hyatt Centric, which is a 5-star hotel in Candolim. So friends, let me end this video by giving a rough back of the envelope calculation for what the company could make 2 years down the line. Now, as per the management, MovieMax is targeting a screen count of 300 screens. In my view, let's take a realistic estimate of 250 screens. The company is expected to close FY23 with a total admit at 26.5 lakhs people and an average spend of rupees 226 per person. That gives it a revenue of roughly about 60 crores for this year. Now in FY25, if you take 250 screens and estimate total admits being 47,50,000 people and multiply it by the average spends per person at rupees 265, that gives you a revenue of roughly 126 crores for FY25. Now a reasonable EBITDA margin of 16% and a net profit margin of 4 to 5% would give it a profit of roughly 6 crores in FY25. That translates to an EPS, which is earnings per share, to rupees 2 per share from the 40 paisa per share estimated in FY23. Now the question is, a lot of things from the debt reduction to expansion to industry dynamics have to fall in place to achieve the strong growth guided by the company. So dear viewers, do let me know of what you guys think of this risky investment. Is it an all or a nothing stock? Do you see the price doubling or do you see the price going to half? Thank you for watching the video and do write to me.